Hello, everybody. This is Jimmy from CREDITSUITE coming to show another little bit of inside information that can help you get some funding, get some capital for your business. So today we're going to discuss how to get business money with good personal credit. We talk a lot about keeping things separate and building your business credit profile, getting access to capital without using your social. But here's some information for those who may be able to use personal credit to help start or excel or grow their current business. So we'll discuss that today. So again, some basic information here. Our CEO, Ty Crandall, does a lot of these videos. I'm filling in for him today. There's a direct phone line for CREDITSUITE if you have any questions. info@creditsuite.com. If you prefer to send email, reach out to us with any questions after this is over. And we'll take care of you. All right, so let's start with business financing. All right, so every business needs money, right? I think everybody knows that. That's why we're here. Most businesses fail due to lack of access to money. So a big statistic there. So every business needs money. Even though business credit isn't technically based on your personal credit, although Experian would beg to differ, there is a place for a good personal credit score when it comes to getting money for your business. So the beauty of it is that you do not have to be the one with good personal credit scores. And I'll talk about that. You can actually work with a guarantor who does. So if you've got somebody close to you, part of your business, somebody who's got a title in the business, a registered agent, a secretary, a vice president, anybody who's got like a vested interest, you can actually use them as a guarantor for your credit. Let's talk about some fundability factors. So your fundability is obviously the ability of a business to get funding, right? It's a fundability factor. So it essentially covers all of the points that a lender or credit provider will be looking at when they're trying to figure out if you can pay back a loan or credit that's extended to you. So these included factors are things you probably haven't thought about or might think that aren't so important, but they really are, okay? The 3 C's capital acquisition formula. This is a term that you've probably heard people say. I say it a lot up here at CREDITSUITE. So when you think like a lender, you realize that all they want to do is they just want to know that you can pay them back. So lenders look at one of the 3 things for loan approval: cash flow, collateral, and or credit, right? Cash flow, collateral, credit. We're going to talk about all 3. But put yourself in a lender's shoes. Would you let somebody else borrow your money if they didn't have one of those 3 things to pay you back with? Probably not. If you would, then we need to talk, okay? So the more of these 3 C's that you have, the more funding options that are available. So today we're going to look at what happens when you or a credit partner have good personal credit score. So let's talk about the credit line hybrid. This is probably the #1 program right now out there that allows business owners to get access to capital fast. This is something that takes a few weeks to do, and you can get quite a bit of money depending on personal credit history. So let's take a deeper dive. A credit line hybrid is a form of unsecured funding. The credit line hybrid has an even better interest rate than a secured loan. You can get some of the highest loan amounts and credit lines for your business. You can get 0% interest business credit cards with just stated income, okay? So not having to provide bank statements, not having to provide tax returns. These also report to the business credit report agencies, okay? You can build business credit at the same time. It's going to get you access to even more cash with no personal guarantee. So a couple things here. They will help you build your business credit. You are going to personally guarantee business credit cards with 0% interest that do not report to your personal credit. Okay, so as you utilize these cards, they're not messing with your personal utilization percentage or messing with your personal credit scores. Okay, so you're building your business credit. You get the capital that you need for the business. Kill two birds with one stone. It's 0% interest, and there's no documentation. So you do not need proof of income to qualify. It's based on personal credit history. So this is obviously why it's the #1 funding program available right now. So let's go into qualifications and some of the terms. So you'll need a good credit score or a guarantor with a good credit to get an approval. They want to see right now at least a 680 or higher, okay? They want to see 680 or higher on all 3 bureaus. So you can't have a 740 on TransUnion, a 650 on Equifax and Experian. They want to see a 680. The reason is because each one of these banks that approve you for these business credit cards, they each use and pull a different credit report. So to maximize your funding, they want all 3 to be above a 680. No financials are required. We talked about that. You can often get a loan of 5 times the amount of your current highest revolving credit limit account. This is up to $150,000. So again, to calculate the 5 times the amount of your current highest revolving limit account, I'll see if we go into more detail there. If not, I'll touch on that again, or I'll tell you now, and then if we repeat it, we repeat it. So how they do this, they want to see your credit card. What the credit card they're going to use is one that's at least 2 years old. Okay, so if you open up a credit card last week that's got $25,000 on there, that they're not going to look at that. They're going to look at how you've managed a higher limit credit card that's over 2 years old. This is how you get the maximum funding. So 2 years old or older, $25,000. Take that times 5. You're right around $125,000. Okay, you got $30,000 credit limits. Up to $150,000, right? 5 times 30. So that's how they do the calculation to get you up to $150,000. Your limit of your current personal credit card that's over 2 years old is going to be one of the biggest factors in deciding your loan amount, okay? There's other things that we'll talk about as well. Authorized user accounts will not count. So make sure it is an individual account here as well. Using authorized user accounts is something they just don't think they hold any weight, okay? So a bridge loan, another opportunity. A bridge loan is going to be a short-term loan used until the person or company secures permanent financing or removes an existing obligation, right? Think of it as a bridge. This is something that's going to get you from point A to point B, and this is the bridge that fills that gap. So it is a bridge loan. That's exactly what it says it is. This allows you to meet current obligations by providing immediate cash flow. Bridge loans are going to be short-term, usually up to 1 year. They have a relatively high interest rate, so these are going to be a little bit higher risk for the lender. And they are often going to be needed to be backed by some form of collateral, like real estate or maybe even some inventory, sometimes heavy equipment, so yellow machinery. But it cannot be a primary residence. So when we talk collateral, it's typically going to need to be business-owned collateral, not your primary home, usually a rental property or maybe some land. Again, inventory is a popular one, heavy equipment, another one. A bridge loan via the credit line hybrid. All right, so the CREDITSUITE credit line hybrid, it has a term loan program. This bridge loan works as either an add-on or in lieu of the program. So when you meet the applicant or when you meet the eligibility and agree to either a portion or all of the funding, and this is supplied in the form of cash term loans, there's going to be a fixed monthly repayment, right? So it's not going to be something that goes up or down. It'll be a fixed term and payment. The CREDITSUITE program is an aggregate program requiring multiple accounts to meet our pre-qualification. You can get anywhere from $25,000 up to $300,000 per applicant. So the APR, your annual percentage rate, is going to be anywhere from 7 to 24%. And this is obviously going to depend on your credit worthiness. The higher and the deeper the personal credit profile, the lower the interest rate, okay? Also, it will typically match currently what you already have on your personal side. So if you have, 15% interest type of like credit cards or loans, you're going to be probably right around that. Okay. You could do 3, 5, or even up to 7 years. Again, 680 FICO score or better. You need to have $35,000 in adjusted gross income, right? So this is something that you do have to provide documentation for, tax returns, recent pay stubs. But if you this is personal income, right? So personal credit scores, personal income. If you're over $35,000 annually in gross income, you're 680 or higher on credit score, then a term loan is something, a personal loan, term loan is something that could help you out. So your actual pre-qualification is going to be dependent on your DTI or your debt to income ratio. Again, this is something that you experience when purchasing a car or a house. This is going to help the lender determine how much is left over at the end of every month, so they can determine how much they can lend you, because you have the ability to pay that loan back on said amount, right? On, whatever the monthly payment term ends up being based on the rate and the term and the funding amount. So debt to income ratio will be determined through this process, just like if you were applying for a personal loan or a car or a mortgage. Unsecured credit cards. So an unsecured credit card means that you didn't put any money down to secure it. You didn't use your own money. It is completely unsecured. No collateral, no money was put up front. So these are seen as a risk, right, to providers. A little bit riskier because you have nothing committed to it, right, except for personal credit. Therefore, the limits can be very low, especially if you have poor personal credit. So it's something that they're going to start you out on a lower limit. As you create good payment history, use the account, pay it back, then you can see those limits increase. And of course, your credit score will increase as well. So here's why having good personal credit really works. Unsecured credit cards. Again, your APRs are going to vary. Again, they're going to match typically what you are used to seeing. They're not going to be twice as high because it's business. They're not going to be half as much because it's business. They're typically going to match what you currently already are seeing on your personal credit cards, okay? Some of them have rewards, right? So you can see cash back options. You can see them waive their annual membership fees. You can see some of them have 0%. So each one's going to have its own benefits or rewards built in. So the better your FICO score, obviously the better your rates, and the higher limits can be. So house reseller financing. So do you currently own a home beyond any house that you may intend to flip? A home equity line of credit is a potential source of funding. A lot of people call it a HELOC, right? So a home equity line of credit is going to be secured by your house. This is a collateral loan. Remember the 3 C's in the very beginning: cash flow, collateral, credit. We just spoke about credit. This is going to be a collateral loan, all right? So you can get financing at a low interest rate, right? You're using collateral. The rates are going to be lower than if it were unsecured. This is technically a secured loan. You're securing it with your property, with your house. If you own a rental property, you may be able to take advantage of an investment property line of credit, okay? So if you own a rental property, you may be able to take advantage of an investment property line of credit. Like a HELOC, you can borrow against your investment property's equity. Again, this property is serving as collateral. So keep in mind, if there were something to happen here and you were unable to pay back the money borrowed against your house, you could lose your house. A lot of people stay away from collateral loans just for the fear of losing their investment, using their collateral. This is why unsecured is very popular. This is why personal credit cards, business credit cards are very popular. They're unsecured. They're not using collateral. There's nothing anybody can take away from you if you can't pay it back if something happened. But that's why they're riskier. That's why they're going to have higher rates and shorter terms. This is going to be your most amount of money typically, your best rate, your best term. It's going to require usually pretty good credit. So all of that's important. But the reason you get all that is because there's collateral there. The bank has something they can get in return if you don't pay them back their money. So house reseller financing, so investment property lines of credit. Here we go. To qualify for investment property line of credit, you're going to have good to excellent credit. Again, I would say 650 or higher right now is what we're seeing. 680, 700 or higher, even better. 740 or higher would be, of course, ideal. With good collateral, with good credit score, 650 or higher, typically you're going to be good to go. So you must own the property for at least 1 year before you're eligible. So this is something that they see that it wasn't a flipping property, right? The lender, they want to see that you've owned the property for at least 1 year. That way they can determine the market, the actual value, the as-is value, and help determine that loan amount. So more options for house reseller loans. Bridge loans, we talked about. Cash out refinance, right? So most of you are probably familiar with that, maybe even done it on a personal property recently. So cash out refinance is you're pretty much pulling out a percentage of equity that you may have in the house versus what it's owed. So if you owe $100,000 and it's worth $200,000, you've got $100,000 in equity. A cash out refi allows you to borrow against that equity. Permanent bank loans or online mortgages. Hard money loans. Let me go back there. So hard money loans are going to be very short term, 12 to 18 months, something you need to refinance out of, or there will be penalties and fees that you'll typically have to pay to the lender if you're unable to pay that initial hard money loan off. You're typically going to be a little bit higher rate than your standard mortgage. It is higher risk. Also typically requires 20 to 30% down to do hard money. So there's definitely some pros there. It's how a lot of people get started in real estate investing and flipping. But hard money loans are something you have to keep in mind. There is some risk there. It's 8 to 12% typically if you're a beginner. On interest rates, it's 12 to 18 months, sometimes up to 36 months. But figure 12 to 18 months to resell that property and pay that loan off or refinance out of it onto a long-term option. And you need to be liquid. You need to have 25 to 30% of a down payment, right? So have that available. You are often going to need to have good to excellent personal credit and a stable history of flipping success to qualify. So again, if you can show that this is something you've done, you're not just starting out. If you've got some successful flipping success, then that's going to help you qualify as well. So the property itself will be serving as the collateral. You can average credit. You can have average credit and be approved with credit scores as low as 640, right? I mentioned 650 earlier, 640 I think will probably work as well, as long as you don't have any recent severe negative credit items on your report. So bankruptcies, collections, any kind of defaults on mortgages, repossession. So major, severe and negative items on your credit report, okay? And if you did, probably wouldn't be 640. So they kind of should go hand in hand there. So let's look at some auto financing options. So whether a vehicle is purchased new or used, it will affect the number of years that you can finance the vehicle and the rates that you will pay, right? Just like everything else. If a vehicle is used, the number of miles on it will also affect the terms. Plus, business owners may be required to personally guarantee vehicle loans. This is something that you can accomplish through building your business credit. We show you how to get access to vehicle financing without being a personal guarantor inside of our business credit builder. It's something that does take about 9 to 12 months to get your business credit in a position to do this. But at the end of the day, the pro is going to be the fact that you have now secured a vehicle for your company without being personally attached. So if anything ever happened, you're not going to be personally responsible for that debt. So in this scenario, let's talk about personally guaranteed options. That's what this video is about. If you are a co-borrower, the loan will most likely report to your personal credit report. Some loans have a prepayment penalty and charge you for paying ahead. This happens. It's very rare. It's very uncommon, but make sure you ask. If you finance a vehicle, make sure you're asking if it's a simple interest loan, if there's any prepayment penalty, okay? and they should say no. And that way you can always pay it off early and save money there as well. Auto financing continued. So in general, the following is going to eliminate the need to provide a personal guarantee for this type of financing. Good business credit, just mentioned it a couple seconds ago. A decent amount of time in business, or good personal credit, right? So they're looking at the overall picture. What are you bringing to the table? If you have good time in business, good business cash flow, good business credit, you can finance a vehicle without being a personal guarantor. If one or none of those things are available to you, good personal credit becomes the alternative. It steps up. It kind of fills in the blanks. So that's what a personal guarantee is. You are a co-applicant for your company. You are saying, I agree to pay this loan amount if my business is unable to pay it on its own. Just like if you were co-signing for, an 18-year-old son or daughter, a kid, So you are personally guaranteeing these loans. Just like any other kind of business borrowing, the more assurances that you can give, the better. All right, so auto financing terms and qualifying. So you're going to need to establish the amount of money that you have for a down payment, the vehicle that you will need, and the costs associated with buying the vehicle. Provide documentation proving that you own the business, like a business license, partnership agreements, LLC documents, article of incorporation, so a copy of your article of incorporation, listing you as at least having 20% ownership in the business. So in order to be a personal guarantor for a vehicle for a company, you need to have at least 20% ownership in order to do that. You may also have to provide personal documentation like personal credit scores and credit history. Again, if the business credit's not strong enough, the cash flow is not there, the time in business isn't there, and you're not able to do this based on business credit and on those factors only, then personal credit becomes involved. Them taking a look at your personal credit history is part of it. If you're a sole proprietor and the business is under your social security number, you are going to be the borrower and the guarantor, right? There's no EIN number there. A sole proprietorship, if you're using a social, then it's all going to be personal anyways. You're going to be the borrower and the guarantor. Hence that you are personally liable for repaying this loan, right? It's all attached to your social. It's also a good idea to have a loan proposal. A loan proposal should detail your business, loan needs, and financial statements, okay? Computer leasing. So just like furniture, you can lease computer equipment. These things can be very expensive. There's $10,000, $15,000, $20,000 printers out there. I mean, depending on your industry and your environment, they could be very expensive for equipment, especially computers. So you can take advantage of tax incentives and also use your cash flow to its fullest advantage. So here we are, that third C. We did credit, we did collateral. Let's talk about some cash flow now. So this is going to include file servers and backup storage, hardware and mainframes, laptops, printers and scanners. These things can add up pretty quickly. So terms can include leasing to ownership, right? A lease to own option. Often leasing provides businesses with a full deduction of lease payments against current earnings. A large part of approval is based on the personal credit and the background of the owners. Here we are, personal credit. This whole video, personal credit. So not on the trade or banking information that startups in particular don't have yet, right? So you're able to bypass the cash flow and the time and business part based on personal credit. Again, it's that overall value that you're giving these lenders to be able to say, okay, based on what we see here or based on what you've brought to us, we can lend you X amount of dollars, right? So using your personal credit in the scenario allows you to overcome, if you're a startup company, you don't have a year's worth of bank statements doing $10,000 a month in revenue, right? So you can lease $500,000 to $250,000, up to $250,000 with this program, and more in computer equipment value. You're going to be anywhere from 2 to 5 years, 24 to 60 months. Here is a shared link to the lender that can help you in this scenario if you're looking for computer leasing, computer equipment leasing options. harrisleasing.com /computer-equipment-leasing. If you can't write this down, this video is going to be available on YouTube here as soon as this is over. And then again, you can always reach out to us with that 877 number we shared in the beginning. And again, we'll share in the end, okay? But harrisleasing.com is a lender that will help you in this scenario if that's the type of funding you're looking for. Inventory financing. Let's go over this. This one's a popular question we get. Inventory financing is going to be a revolving line of credit, right? So this is ideal. Most business owners love having a revolving line of credit. It's like a credit card. You use it, you pay it back, you borrow it again. You use it, you pay it back, you borrow it again. It's over and over, a line of credit in that way. Revolving just means that this isn't like a net account. This isn't something that has an end. You can pay it back monthly until it's paid off. So revolving, again, is just like a credit card. This is not a term loan. All right. So this is acquired by a company so it can purchase products for sale later, right? Inventory. The products serve as the collateral for the loan. There can still be a minimum FICO requirement, okay? Also, there may be restrictions on the type of inventory that you can use for this. So this would include not allowing cannabis, alcohol, firearms, etc., or perishable goods. So anything that seems high risk, they're not going to lend money on that type of inventory, okay? This is really good for, online e-commerce retail businesses, clothing, shoes, equipment, machinery, things like that. So some kind of product or good, not perishable good. Sometimes there's revenue requirements as well, okay? Again, this is going to help show the lender that you have the ability to pay back the money that you borrow. That's the reason people look for revenue. When you go apply for a car or a house or anything, a personal loan, you have to provide tax returns, pay stubs, bank statements sometimes. They just want to see that you have the ability to pay back the money they let you borrow. The same thing that you would do if you let somebody else borrow money from you. So there can be revenue requirements for that reason. Again, pretty standard here. Inventory financing terms and qualifying. All right, but still, you're going to get approved for a line of credit anywhere from 50% to 60% of inventory value, okay? 50% is very common. Very rarely do you see 60%. So let's just say 50% of the inventory's wholesale value, okay? I think we'll probably cover that, not its retail value. So regardless of personal credit quality. You're going to be anywhere from 5 to 15%, depending on the type of inventory. They will have that conversation with you and let you know where you fall. 3 weeks or less for the timing on the funding. So this is very fast. This helps a lot of business owners out and getting access to this capital in a timely manner, so they don't miss out on purchases or sales or just an opportunity to make some money. So funding in 3 weeks or less. So it can be lumped together inventory, like office equipment. So if there's a minimal value that they want to see to lend you money, let's say it's $500 or $5,000, and you've got a number of products that total and equal that, then they can actually lump all that together to help with the loan. Okay, so an SBA, very popular. They're very busy right now over the last year. SBA application process. So they do want to see good personal credit scores. This will help them decide whether to lend to your business. A great FICO score is going to increase your chances of approval, right? The SBA has several programs. The ones that we're going to touch on today are going to be your CAPLines, CAP lines, a 7A, and a 504, okay? So you're going to get up to $5 million with any CAPline program. Up to $5 million, okay? Not everybody gets $5 million. It is up to $5 million. That's their max. Finances direct labor and material costs associated with performing a signable contract. So this is based on a contract line. A working capital loan. The borrower, being you, must use loan proceeds for short-term working capital or operating needs. Do not take a working capital loan and go to Hawaii, okay? Make sure you're using it in your business. A builder's line. So this is meant for general contractors or GCs or builders who are constructing or renovating commercial or residential buildings. Very popular. Okay. A lot of people want to get in real estate or in real estate. So a builder's line is what you're going to be looking into in the SBA cap line. Okay. This is for general contractors or builders who are constructing or renovating commercial or residential buildings. A seasonal line advances against anticipated inventory and accounts receivables, or in some cases, associated increased labor cost, right? So there are some companies that are seasonal, depending on what part of the country you live in or work in. Seasonal jobs are a thing. So a seasonal line, this is going to give you an advance against any kind of anticipated inventory and accounts receivables, or in some cases, increased labor cost. Okay, 7A. This one might be the most popular one. The SBA's most popular loan. There you go. It just said it. All right. SBA guarantees 85% for loans up to $150,000, right? Real popular with somebody with good personal credit, startup companies, things like that, a 7A loan. But look there, 85% they're going to guarantee. The other 15%, guess what? It's coming from you. 75% for loans greater than 150. So they're going to reduce their commitment at 75%. The other 25% is going to be a commitment from you. So the SBA makes the lending decision, but qualified lenders may be granted delegated authority to make credit decisions without SBA review. All right. So the maximum amount on an offer is $5 million. You're going to have to provide articles of organization, business licenses, and documentation of lawsuits, judgments, bankruptcies, or any other pertinent documentation. If there's anything like liens or anything like that, okay? So lenders are not required to take collateral for loans up to $25,000. So if you keep this loan amount below $25,000, they will not request collateral. For loans over $350,000, they will require that the lender collateralize the loan and the maximum extent possible up to the loan amount. So again, $350,000 or higher, they're typically going to want to see, well, it will be required. They will ask for collateral, typically something of that value or more, okay? A 504. The SBA 504 loan program is going to be an economic development loan program. It offers small businesses an avenue for business financing while promoting business growth and job creation. This program is going to provide small businesses with long-term fixed rate financing used to acquire fixed assets for expansion or modernization. Use it to buy currently existing buildings or construct new buildings and more. This is a good one to take a snapshot, write down, watch the video later, look it up, sba.gov/offices/headquarters, a lot of slashes, /OFA/resources/4049. So something, again, to help you, SBA 504 loan program. Terms and qualifying. For corporations, anyone with a 20% ownership or more must fill out the application. So this means everyone, not anyone, everyone that is 20%. If you have 5 owners at 20% apiece, all 5 owners will need to be filling out the application. If you're 50-50, both applicants, both owners fill it out, okay? If you have one at 19% and one at 81%, only the one has to fill out the application. So anybody 20% or more will be on this application with SBA. So in general, the SBA provides 40% of the total project cost. A participating lender covers up to 50% of the total project cost. The borrower contributes 10%, okay? Under certain circumstances, a borrower may be required to contribute up to 20% of the total project cost. Each case will be looked at individually. They'll explain that with you. SBA Microloans. So if you don't need a lot of money, an SBA microloan might be right up your alley. SBA Microloan lenders, they are nonprofit community-based organizations with experience in lending, as well as management and technical assistance. So the Small Business Administration, or SBA, provides funds to specially designated intermediary lenders. These intermediaries administer the microloan program for eligible borrowers. Okay, so an SBA is going to provide funding to lenders, right? These intermediary lenders. And then these lenders are going to administer this microloan program for eligible borrowers. It is to help small businesses and certain not-for-profit childcare centers start up and expand. Okay, small businesses and certain not-for-profit childcare centers and startups to expand. So this is something that is right up your alley. You could go right to your bank or credit union and ask them about a SBA microloan and see if that they may be one of those intermediaries. Okay, and they can administer that program for you. Terms and qualifying. So the microloan program provides up to $50,000, still quite a bit of money. The average microloan is about $13,000. So each lender has its own lending and credit requirements, right? They're administering the money from the SBA. They each have their own lending and credit requirements. So make sure you ask and check into that. Much of the time, intermediaries require some type of collateral as well as a personal guarantee of the business owner. This is to be expected. This is cash accessibility. Anytime you access cash, a personal guarantee is going to be required. So expect to be a personal guarantee. There again is a link to help maybe point you in the right direction. More information on loans, grants, and then what SBA has to offer. Microloan program. Term loans. These are highly requested. So a term loan, the banks are going to often they're often the first place that we think of when thinking of financing. Big banks only sign off on about 25% of small business loan applicants that come in their way, right? So at least 75% of y'all that cannot go get a bank loan for your business. A term loan often has lower interest rates than many other funding options. They also tend to give you higher loan amounts. Term loans, terms and qualifying again. So generally speaking, the companies banks end up funding have very strong financials and near perfect credit scores. They'll most likely have to undergo a personal credit check. These kinds of loans may require collateral. Not common here with a term loan. A term loan is going to be, right, a fixed rate, a fixed term, personal credit check, typically no collateral, definitely going to require the ability to pay that back. So cash flow, proof of revenue, okay? To recap, good personal credit is going to be a terrific asset to have. It can help you get money in different types of financing, including the coveted SBA loan, right? Your best rate, typically your highest amount of money, your longest term. An SBA loan is going to be the most sought after. And there's multiple options there that we just covered. The equally desirable CREDITSUITE credit line hybrid, that's the one we spoke about in the beginning. That's the 0% interest business credit cards that you can qualify based on your personal credit history. You do personally guarantee those credit cards. They do not show up on your personal credit report. And you can get up to $150,000 in about 3 weeks' time. The best part is if you don't have good personal credit, all you need is a guarantor who does. Okay, so somebody that's close to you, like we mentioned before. So here is our contact information again. Contact us at 877-600-2487 or info@creditsuite.com. And we will take care of you, answer any questions you may have. Also, some more information, some free training available for you. Info@creditsuite.com, same phone number, www.creditsuite.com. If you look at the top right-hand corner of our website, you'll see the option to do that. Thank you, everybody. Have a great day.